Stocks are lower for the first time in 3 days as earnings season is about to ramp up, and investors fret about the yield curve. With all the confusion and sector rotation we've seen, where are the buys in this market, and what's one name to stay away from? Joining me now is Ari Wald. He's managing director at Oppenheimer, and he's got 3 buys and a bail for us. Ari, welcome. And let's start with Regeneron, which is kind of from left field, but you say it's one of your favorite charts. It's hitting a fresh all-time high in today's trading, and the FDA just greenlighted a priority review for Dupixent for use in patients 12 and older. Tell me what you like here.
Yeah, and it fits into the yield curve story as well, the death cross of economic indicators where you could actually back test it. Actually, markets can continue to do well, but what we found is that this isn't the time where leadership changes. You want to stick with what's working. That high momentum has outpaced low momentum going back to 1978, typically when the yield curve is inverted. So where is the momentum? Where's the leadership? It's in large cap biotech, the S&P 500 biotech industry above its 200-day average on a relative basis versus the S&P for the first time since July of 2020. And I think it's all the more exceptional when you consider what's going on the small cap side of the industry. So yeah, Regeneron, it's one of our favorite charts in the industry. Why? It's breaking through multi-year resistance going back to 2015. I think you stick with that strength. The breakout point at 65 is now support. And some of our conservative upside projections point to closer to $800.
Wow. I mean, a 7-year breakout is pretty notable to begin with. And could people then kind of look across large cap biotech for similar opportunities, or do you think this is a unique one?
It's the broadness across the industry as well. We're seeing it in Vertex, AMZN, now Insight reversing a multi-year decline as well. So it's broadening out. And again, small cap biotech still has issues, but that money's got to go somewhere, and it's going into large cap, and it's thematic. Again, it's across the board in all those large cap biotech companies.
Yeah, and the timing makes sense to you, given everything that's happening in terms of the macro backdrop. All right, let's move from that to Walmart. Maybe a more straightforward story, maybe not. I mean, it's already near an all-time high of 154 at a time when people are debating the strength of the consumer. You think it's poised to break even higher?
Coming into its all-time high, I think you get the breakout. And this fits our market outlook nicely. Reasons to be cautious going into the summer months, that we think low volatility stocks are warranted in the portfolio, really just given really still poor and weak internal breadth and looming weak seasonals about a month away too. So one of those low volatility industries that are a standout to us is food and staples retailing. Why? Again, it's the broadness. The leaders in the group have been Costco, Kroger, BJ's Wholesale breaking out as well. And I think that strength broadens out to Walmart next. So it's had a nice run in recent weeks. It's rallied right into its peak going back to 2020. That's at 154. But again, with the industry tailwinds behind it, aside from a near-term pause to refresh some overbought conditions, I think we're talking about a breakout looking out the next few months.
Yeah, and on that note, Amazon, you're seeing kind of a similar setup. That stock's actually up 13% in the past month, even though it's been a tough slog since the pandemic really set in for Amazon, and it's facing unionization headwinds. So this one also acting well to you?
Yeah, the strength is meaningful when you consider what's happened the prior 18 months. 2021, pretty much a flat year for the stock, had a sold off to start the year, was 18% below its 200-day moving average. If you look at the last decade, it doesn't get much worse than that for Amazon, about 18% below its 200-day average. So we think the strength we're seeing is a meaningful turn. This is a bit more of a longer-term rotation idea. Could use a little bit more time, and it could get whipped around by the market over the near term. But I think as some of our cycle work strengthens again in the fourth quarter of this year, I think we're talking about a breakout to new highs above 3,800 for Amazon.
Okay, so Amazon, Walmart, Regeneron, those are your buys. And the bail is a transport stock. It's already down for the 5th straight session today. FedEx. This after last week's announcement that founder and CEO Fred Smith is stepping down June 1st. This stock is 33% off the highs area, and you think we maybe should brace for even worse?
The charts are still pointed lower, Kelly. I'll tell you that. So the industry, the transports industry as a whole, had a really tough week last week. Sold off, and FedEx sold off with it. And this was the laggard going into that weakness. And I am of the view that when the market tide, or in this case, the industry tide recedes, the weak do get weaker. And if you look at FedEx, you look at the 200-day average, it's pointed decidedly lower. That's indicative of a bearish trend. To me, this is a stock that looks like it wants to test that March low at 199 at the least.